All right. Good afternoon, everybody. Thank you to everyone who's here joining us today. I'm Lisa Partida with Home Again LA, and today we have Tom Fuentes with Bank of Hope. And today's topic is going to be borrowing basics. So sometimes, you got to borrow some money to pay off a couple of things or, maybe some debt that you have going on. So I'll go ahead and pass it to Tom to, dive right in for us.
All right, thanks, Lisa. Yeah, so today is borrowing basics. We're going to go over quite a few kind of definitions and like key terms and stuff, but this should be kind of a fast one because we were talking offline, and the last section is what to do if someone else manages your money, like a wealth manager or something. So we're not going to cover that because it's very specific, but Um, so borrowing base is our first section. We're going to cover ways to borrow money and what it costs. We're going to talk about the different kind of loans that are out there, distinguish the difference between unsecured and secured, because sometimes you need to have collateral to borrow money. And we'll talk about what the key terms mean too. And we're going to go over the costs associated with borrowing money, and then how you compare loan offers and then what a Truth in Lending Act disclosure is. There's also parts in the participant guide that you can check out after the workshop. Uh, they're in try it and apply it sections, which you'll see. It's kind of meant to um, do on your own time as like a homework kind of situation after you've kind of learned the key terms and stuff. But the key takeaway is going to be from the section one of two sections that we're going to go over. Be sure you can afford the payments before you get a loan, before you sign on the dotted line. Also, know how much it's going to cost and what will happen if you can't pay the money back. We're going to go over all of that. So, but what does borrowing mean, right? Let's define our terms. So, when you borrow money, a lender like a bank, like Bank of Hope that I work for, provides you money and you have an obligation to pay it back. And the way that you pay it back is in interest. The more you know about borrowing, the easier it'll be to make borrowing choices that are going to be right for you because all of our situations are going to be different. Here's some key terms. So, what is credit? Credit is the ability for you to actually borrow the money. Debt is the money that you owe the person or the business. So, debt is what you end up incurring by borrowing the money. When you use credit to borrow money, you incur debt. So the idea being that if you want to buy a truck, you'd have to get a car loan. So if you don't have enough money to pay for that truck in cash, you'd have to borrow money from a bank. So that's the money that you're going in debt with because you owe that money back. You also are going to end up owing money back if you use a credit card. So well, let me make a distinction here because the words credit and debit as key terms are confusing too. Because when I talk about a credit card, I don't mean a debit card. Remember, a debit card is the kind of card that's linked to your checking account that when you swipe it, takes money directly out of your checking account. When we refer to the credit card, we mean that you're actually taking money out. And we'll go over what that is because it's a type of loan, essentially. Um, but that's the key distinguishing difference. So you can incur debt by using a credit card that's not tied to your checking account. But let's go into what types of loans there are and how these key terms fit within those types of loans. So there's main two categories that you have to remember. There's installment loans and revolving loans. Credit cards fit into the revolving one, but we'll go over that in a sec. So let's define our key terms, installment and revolving. An installment loan is usually repaid in equal payments or installments for a specific period of time, usually for several years. Think about fixed rate mortgages. So, like when you borrow money to buy a house, typically these are fixed uh, over 15 or 30 years, and the rate usually doesn't change. So that's a fixed rate mortgage. Think about that in our under installment loans. You can also think of that truck loan that we talked about. Typically, truck loans, the rate, the interest, the money that you're paying back to the lender is fixed. It doesn't change. And it's over a set period of time, typically 60 months, 72 months, 84 months. Also, student loans, when you borrow money to go to college, this is typically at a fixed rate. Sometimes it could be variable, depending if you get federal loans or private loans. and they're typically paid over a set period of time. So that's an installment loan. Those are three examples. What about revolving loans, though? Or typically, you can also hear this referred to as a revolving line of credit. This allows you to make unlimited purchases up to a pre-approved dollar amount. That's why I slotted credit cards in as the example. Um, Credit cards, you're going to go to a bank and they're going to approve you for a credit card. When you get that credit card, it's going to be uh, approved up to a fixed amount. So hypothetically, let's say that the bank gave us $5,000 on our credit card. That's the amount that we're going to that's our max that we can use on our credit card, and they're going to charge us interest so that we can use it. But it's revolving. There's no end to it. As long as you make the payment on time regularly, uh, the credit card will stay open. So it just keeps on revolving. It keeps going. There's no end to it. Okay. Another example of a revolving loan would be something like a home equity line of credit. I don't know if you've seen it, but the acronym of it is HELOC, HELOC. This is also another type of revolving loan. There's no set time at which you have to pay it back like a home mortgage would be. It revolves as long as you're paying back the amount that you're um, using. Okay, kind of like a credit card. All right. So those are like the two typical ones. But there's also things like rent to own services, which are not loans. But they can be utilized as an alternative to loans. So rent to own services let you use an item for a period of time by making monthly or weekly rental payments. If you want to purchase the item, your rental payments will be partly credited toward the purchase price. The store will set up a plan for you to rent the item until you pay enough money to own it. If you choose not to purchase the item, you would return it and at the end of the rental period and generally will not receive the money back. You know, another way to think about this is rent to own services. I think typically this kind of falls into the furniture category a lot of times, or the household appliances category a lot of times, where you're renting to own large purchases that are typically a lot of money. But another category that we can throw into these would be something like, remember we talked about that truck loan? Well, maybe you don't want to buy a car, but you want to lease a car. There's some uh there's some programs out there that would allow you to lease a car with the option to buy it in the end. Typically, though, the amount of money that you're paying during the lease doesn't go towards the purchase price. So I guess maybe this isn't the best comparison for that, but it can kind of fit. Um, so as an aside, that rent to own, it's not a loan, it's an alternative. But another alternative would be something like a layaway. Buying on layaway, typically you would put down a deposit, usually a percentage of whatever it is that you're purchasing, and then you pay the balance over time. The store holds the merchandise for you. You take the merchandise only when you've paid it in full. Um, but just like any other service, like the loans that we talked about, whether it's an installment loan or a revolving loan, or if it's rent to own, or if it's buying on layaway, it's always important to make sure that you're reading the plan that you're signing up for, like when you do the layaway plan, because you want to make sure that you understand the consequences if you miss payments and the fees associated. This is any time that you're borrowing money in any capacity, really. And then specifically for the layaway is you want to make sure that you understand the refund policy. If you decide that you don't want the merchandise after you've made some or all of your payments, do you get any money back associated with it? Let's talk in a little bit more detail about going back to the loan category. So we already talked about the two types, right? So the two types are installment and revolving. But what happens? We have two new key terms, secured and unsecured. And how does that fit in? to revolving loans and installment loans. So, with a secured loan, you pledge collateral to secure repayment of the loan. Collateral is an asset that you own, such as your house or your truck or cash. Um, if you can't repay the loan as agreed, the lender can take your collateral and use it to get some or all of the money back. You may be responsible for paying the remaining balance on the loan if the collateral doesn't sell for enough money to repay the debt. Mortgages and auto loans are usually in the category of secured loans. When you take out that 30-year fixed mortgage, your house is the collateral component. When you take out that 60-month car loan to buy your SUV, the car is secured against that loan. If you can't make the payments, the bank can take those from you so that they can get part or all of their money back. But there's also things that are unsecured. So unsecured loans are made based only on your promise to repay the money that you borrowed. They are not secured by any collateral. Lenders consider these loans more risky than secured loans, so they may charge you a higher interest rate than if it was secured. Credit cards and student loans are typically classified as the unsecured loans. When you get that credit card that we already kind of talked about, it's not secured to any collateral. The bank's not asking you to put up something to use the card. Um, but let me tell you, because remember I said these are a little bit more risky, and the bank will charge you a higher interest rate. Um, let's compare the house loan to the credit card really quick in terms of how much money it's gonna cost you to borrow these two things. Okay. Right now, a home mortgage loan, I think the interest rate is between like 6 and 8% for a 30 year. But the interest rate on credit cards, depending on your credit, depending on your credit score, that can be like 25 to 30%. So because the credit card isn't secured to collateral, the bank is charging you more money in interest because it's riskier for them to give you the credit card. Same things with the student loans. When you go to college, the the federal government, because there's federal loans, but there's also private loans. The federal government's not asking you to have any collateral when they're allowing you to borrow money for your education. You're just agreeing that you're going to pay it back. So typically, student loans have a higher interest rate than something that like a secured loan, like a car loan. So those are the two differences. Remember, secured is tied to collateral. That can be taken away from you if you don't pay the debt in full and on time. And then the unsecured is it's there's no collateral tied to it, but you're going to get charged a higher interest rate more than likely. So I keep using this term interest, right? Let's actually go more in depth about the cost of borrowing money. So it's important to know, the cost associated. When you borrow money, it doesn't come free. You're generally going to repay more money than you borrowed. Credit cards are generally the exception, though. If you don't carry a balance on your credit card and you pay the current charges in full by the due date, um, you're not going to pay more than you borrowed because they're not going to charge you interest. So you can use that credit card, swipe, but as long as you pay it off by the due date, you don't incur any interest. In addition to repaying the money that you borrowed, this is called the principal. So we got three new key terms here. You generally have to pay two costs associated with borrowing money. That's interest and fees. So let's talk about that. So remember, key term one right here, the money you borrowed is the principal. What's interest? What's fees? So interest is the amount of money a financial institution charges you for allowing you to use its money, and it's expressed as a percentage, and it could be fixed or variable. Remember, I talked about car loans and mortgages and how typically those are fixed rates and they don't change. Fixed rates stay the same during the term of the loan, except with most credit cards where the rate can change if the bank gives you due notice. Variable or adjustable rates might change during the term of the loan. The loan agreement explains how the rate will change. Typically, when you hear um, the variable or adjustable rates, my brain always goes to the 2008 financial crisis that had to do with a lot of the mortgages that were tied to adjustable or variable rates. That's what I always think of as an example, but there's a lot more out there. Um, okay, so let's talk about fees. So fees may be charged by lenders for certain activities such as reviewing your loan application and servicing the account. Common examples of fees include origination fees for home mortgages or late fees if you don't make your credit card payment on time. Lenders often subtract fees from the loan proceeds before they receive the loan money. For example, if you borrow a grand and there's $100 fee, you may only receive 900. Okay. There's also other fees. Let's talk about some more key terms. Prepayment. Prepayment is an early repayment of all or part of a loan. When you prepay, you pay the lender more than the amount of your regular monthly payment. You have them apply the extra amount to your outstanding balance. If you prepay your loan in full, you will stop paying interest because you no longer owe the money. If you prepay part of your loan, you could reduce interest cost. You may finish paying off your loan altogether earlier. The prepayment is one strategy for reducing the cost of borrowing money. Some loans have prepayment penalties, though. Don't forget, that's why we need to read the disclosures before we sign on the dotted line. We'll get to that in a minute. So a prepayment penalty charges a fee for early repayment of all or part of a loan. The specifics vary from loan to loan. So when you shop around for a loan, find out whether loan offers have prepayment penalties. Now, in our first try it section in the participant guide, which you can check out after the workshop, I'll give you kind of the start of it, but then you can check it out afterwards. Um, so we have a scenario here. Ben explores her options for buying new furniture. So this is going to tie in to the kind of key terms that we talked about when we talked about unsecured loans and installment loans. So there's a couple of options within here, but essentially she could get a 36-month unsecured installment loan for 1,000 from her local bank. She could keep her savings for an emergency instead and buy the furniture using a credit card. So that's another scenario. She could opt to purchase the furniture on layaway, but then there's also a rent to own option. So check this scenario out in the participant guide because it's going to cover the different ways that Ben can go about purchasing the furniture and which would be right for her personal situation. I don't think we have the chart here to explain. No, we don't have the chart, but essentially, this is a good exercise to go through to figure out the options in a scenario of when you're trying to purchase something and what would be the best for your current financial situation. So check out the scenarios and see which one Ben ultimately considers and what you um, think the right answer would be. So remember prior, we talked about reading all the terms before you sign on the dotted line, before you agree to borrow that money. Okay. This is going to be, again, this is going to be a good exercise because you can see the the scenario in which Ben goes to decide which is the best pathway to buy the furniture. this perfectly segues into how you're going to compare offers, okay? Because you want to shop around before you get a loan. Let's talk about TILA. The Federal Truth in Lending Act requires lenders to give prospective borrowers a written disclosure that states the loan terms in clear and in a uniform manner. You receive the TILA before you sign on the dotted line for the loan. These disclosures can help you compare loan offers from different lenders. They can also help you decide if you can afford the loan payments comfortably each month and pay off the loan according to the agreement. The law also requires lenders to provide the written disclosure before someone agrees to borrow money and signs the loan documents. Let's look at what a very simple um, TILA would be. So you can see in part of the sample of the TILA disclosure. Um, oh, by the way, disclosures will look different depending on the kind of loan we're talking about. It could be a car, it could be a home mortgage. Some student loans will look different. So everything is going to look different here. But what I want you to understand here, and we're going to introduce some more key terms. We're going to introduce annual percentage rate or APR as a new key term, finance charged, amount financed, and total payments. So those four key terms on the top of our chart from left to right. So let's talk about what this would look like as part of this sample TILA disclosure. So for an installment loan, TILA requires lenders to disclose several items. Sorry, I should have turned off my, whoops. Sorry about that. Um, so TILA requires lenders to disclose a whole bunch of items. Let's talk about them real quick. So annual percentage rate or APR, this is the cost of your loan expressed as a yearly percentage rate. The APR reflects certain fees in addition to interest. The APR on the $5,000 loan in this example is 12%. Okay. Now, we also have finance charge. This is the cost of credit expressed in dollars. The finance charge includes interest and certain other costs, such as loan fees. For this example, the APR is 12%, and there are no other fees associated. So therefore, the finance charge is $600 because 12% times 5,000 equals 600. Now, let's cover the amount financed. So this is the amount of money you're borrowing. It is also called the principal. Remember, we talked about that as a key term a while back. For this example, the amount financed is $5,000. Okay, so you can see that at the bottom of the amount financed. But they also need to disclose you the total of the payments. So this is the amount that will have been paid after making all scheduled payments. This includes the repayment of the principal plus any of the finance charges. So using this example, the total of payments is 5,600. Remember, the 5,000 is the principal, but the 600 is the finance charge as a result of the 12% that the bank is charging us. It can also be important to review the payment schedules for installment loan offers to understand how differences in the terms of each offer affect the amount that you pay. For example, an installment loan might include a balloon payment. A balloon payment is a larger than usual one-time payment at the end of the loan term. If you have a mortgage with a balloon payment, for example, your payments may be lower in the years before the balloon payment comes due, but you could owe a big amount at the end of the loan. The TILA also applies to credit cards. As with other types of loans, lenders must provide you key facts, including the APR, so that you can better understand what it is, so that you can shop around for a credit card in this example. For revolving loans, like borrowing on a credit card, it can be helpful to compare offers based on what would happen if you paid only the minimum amount each month. Online calculators can help you, um, how long it would take to pay off the balance. and how much you would pay in interest based on the terms of each offer. You can also look on your credit card statement for useful information on how long it'll take to pay off whatever your balance is. But the key takeaway from this section, as far as the TILA, is I want you to be able to cross compare. Um, I want you to cross compare and shop around when you're looking for loans or credit cards. So when you're ready to borrow money, research the best thing that's for you. Evaluate the payments required by the loan to be sure you can pay as agreed. This will limit the risk of damaging your credit history or for secured loans losing your collateral. You can use the TILA disclosures, in particular, there's the APR that we talked about in this scenario, to better compare your loan options. Because the smaller we can get the APR, remember in our example it was 12%, if we can get it lower, the amount that the finance charge will make the total amount of the payments lower. So that's why we're going to shop around. We're going to try to find the best APR. You can visit consumerfinance.gov and search for compare loans to find tools to help you compare loans. You can also seek help from a HUD certified housing counseling agency approved by the U.S. Department of Housing and Urban Development, HUD, um, to find a credit counselor or to help you. Maybe you want to buy a home. There's a lot of organizations out there that help with first-time homebuyer workshops. They tend to be free. So credit counseling agencies are a good can be a good resource for you. All right, so that's section one. We have one more to talk about, but the key takeaway is be sure you can afford the payments before you sign on the dotted line. Look at the disclosures and cross compare and shop so that you can make sure that the money that you're borrowing is right for you, so that you can make sure you can actually pay that money back. So, lastly, we're going to talk about preparing to apply for a loan. We're going to go over factors lenders may use to evaluate their applications, identify ways to improve how lenders might evaluate you as an applicant, and then distinguish between a couple of things like co-borrowing, co-signing, and some other related risks. So our key takeaway is going to be considering what lenders look for when deciding to loan money helps you to better be prepared to apply. So when you apply for a loan, the lender will decide whether you're a good credit risk. In other words, are you likely to pay back the loan as agreed? This can also be referred to as evaluating your credit worthiness. And essentially, there's key factors that break out into the C's. Uh, Lenders could refer to them as the four C's or the five C's. These are essentially kind of like scorecards that they use. Let's talk about these. First is your credit, sometimes called your character. How you have paid your bills or debts as shown on your credit reports. So that's your credit character. There's also your capacity, your present and future ability to meet your payments. And then there's also your capital, the value of your assets and your net worth. And then there's also your excuse me, also your collateral for secured loans only, the assets you offer to secure the loan. Some lenders also like to use another C called conditions. This refers to how you plan to use money or may refer to overall economic conditions. For example, the lender may approve your loan application only if you will use the money to pay off another debt, for example. So, credit character. Your credit report gives lenders the history of how you've paid your debts. Lenders use your credit reports and your credit scores derived from them to evaluate items such as how you've used credit in the past, how many credit accounts do you have, whether you've ever filed for bankruptcy, had property repossessed or foreclosed upon, or if you've made late payments. Um, before you borrow money, consider getting your free credit report. This can help you get prepared to understand what your credit character looks like. Let's go into more depth about capacity. Capacity refers to your present and future ability to meet your payments. Lenders evaluate how much of your monthly income currently goes into payments on debt. How much of your monthly income will be going to debt payments if the lender lends you money, called your debt to income ratio. It helps the lender determine how much money they think you can afford to borrow. How long have you been employed, including how long you've been with your current job and your recent employment history. Also, how much money you make each month, and then what are your monthly expenses? So that's your capacity. What about your capital? Capital refers to the value of your assets. This is your net worth. How much money is in your checking and savings account? Do you have any investments or other assets such as a house or a car? The value of this is your net worth, which is your assets minus your liabilities. So you can also think of your net worth as the value of all your assets after the liabilities that you've paid. So that's your capital. That's the C for capital. What about collateral? Collateral only applies to secured loans. So it refers to the assets that secure the loan. We already kind of covered this, right, with the home mortgage. Your house would be the collateral. What about the conditions that we talked about? Conditions depend on the type of loan and can include how you plan to use the money and overall economic conditions. To get better understand and prep to get ready to borrow money, in our second try it section in the participant guide that you can check out after the workshop, we have another scenario here. Chandra gets ready to borrow money. She's thinking about modifying her van to help her father who needs wheelchair accessibility. Um, but Chandra has a lot of things to consider, uh, which is going to be the capacity, capital, credit, and the character um, that is associated. So essentially, in this scenario, you're going to go through to discover whether or not Chandra has the ability to borrow money. I don't think we have the grid here, but I'll verbal. Oh, we do have the grid. Oh, awesome. Okay. So we do have the grid. So essentially, we pose the question, and then we're going to go through to see if she has the capacity, capital, and credit character. To give you an idea of what this would look like on the try it section, let's go over the first question first. So ultimately, to get yourself ready to borrow money, pretend you're the lender. Would you approve Chandra for this loan? So complete the worksheet after the workshop. Um, let's consider the first question in evaluating. So, what will reflect positively on Chandra? Will what will reflect positively? So, incapacity would be something like stable employment for the past 2 years. Another part of capacity would be none of her income currently goes to paying debts. So we would get this from the scenario here. What about the capital? She has a car, her savings for a down payment, and she has money set away for an emergency fund. Okay. What about credit or character? The work she did to eventually pay off her credit card debt in the past. So go through the rest of the grid, and you're acting as the lender going through to see if her C's are good enough that you would be lending her money in this scenario. So it's kind of a good exercise to go through to figure out whether or not um, she has the C's to get ready to borrow money. And then it can help you reflect on your C's as well. Um, let's go over two more key terms, co-borrowing and co-signing. So co-borrowing is taking out a loan jointly with one or more other people. Times when you might want to co-borrow is buying a house. When I bought my house, I certainly didn't have the C's available to buy a house on my own. So my wife and I bought the house. So this would be an example of co-borrowing. We're both on the mortgage. And we needed our C's combined in order to get approved for the loan to buy the house. As a co-borrower, you must repay the debt um, uh, between you two jointly. But it just doesn't have to be your partner. You could buy property with your children or your parents. I mean, you can essentially co-borrow or be a co-borrow situation for anyone that you know. Um, But the nice thing about co-borrowing is that lenders are going to consider the credit worthiness of all the borrowers. So, like I said, I didn't have all the C's. My wife didn't have all the C's, but jointly we did. So our credit worthiness went up. The lender wasn't evaluating just based on my credit worthiness and my wife's, but us jointly. So that could be a good, reason to co-borrower. But the so what is co-signing? Okay. So, um, co-signing is different than co-borrowing. The loan proceeds go to the borrower and not the co-signer. When you co-sign, you promise to pay the debt if the borrower does not. So it's a little different. You will likely also have to pay late fees or collection costs if the borrower defaults on the loan. Co-signing is common with things like student loans. If you have um, if you have your son or daughter, for example, who's going to be going to college, you as the parent can co-sign on that loan. Um, the responsibility to pay that money back um, is going to fall on you, but you're not the one that's borrowing the money. It's your son or daughter to go to school. So it's a little bit different. Also, co-signing is common with rental agreements. Um, First-time borrowers and private student loan borrowers sometimes need co-signers, like I mentioned. Um, So you're not borrowing the money, but you're obligated to repay it if the borrower can't. But just like the co-borrowing situation, the lender is assessing your credit worthiness together. So your student may not have the credit history in order to take out that loan, but you might as the parent. So you might want to consider co-signing their loan to have them better able to get approved for that student loan, for example. We have in our apply it section my tip sheet for considering co-signing someone else's loan. You can complete the worksheet after the workshop, but essentially you're going to review this tip sheet if you are considering co-signing on someone's loan. There's a couple of questions that you're asking yourself. Can I afford to pay this loan? Will co-signing affect my ability to get the credit I need? Do I understand exactly how much money I might be obligated to repay? Do I understand what I might lose if I co-sign? Um, Ways to protect yourself as a co-signer. I don't think we have that. Um, but essentially, completing the worksheet on whether or not you want to co-sign, there's going to be a tip sheet on what you might do um, to decide if you want to co-sign. I think this is super useful in that student loan scenario. Um, because again, if the student's unable to repay, you're going to be obligated to pay that money back. You didn't borrow the money, but because you co-signed on it, you're on the hook too. Essentially, that'll bring us to the end of the workshop. The key takeaway from section two is understanding what lenders look for. Remember in the 4 or 5 C's category so that you can get better prepared to borrow money. We're going to end it there. We're not going to go into borrowing money when someone helps you manage your money because that's super specific. And I think it's just too specific for what we want to cover here. Um, but I hope that was helpful. I think the 5 C's are super helpful to help getting you ready for buying a home or a car. a lot of lenders use that um, to assess whether or not you're ready to borrow money. So I hope that's a little helpful.
Thanks, Tom. I think the five C's are very helpful. And I mean, right now we just need all the information we can get, because yeah, if you want to get a car loan, you need to need to be working on all of this stuff. All right.
Yeah. And I think shopping around is going to be helpful too because kind of you want to lessen the amount of money that you're going to owe. So
Mm-hmm.
the lower APR, the more you'll save in the end because you'll get charged less in interest.
Yeah.
But just before you sign on the dotted line, really ask yourself, can I pay this back? Because boy, I'll tell you, when I was younger, I was just using that credit card and I bought a car that was super hard to to pay for. So just ask yourself, can I afford to pay this back? Yeah.
Got it. All righty then. Thank you so much, Tom. We'll catch you the next time around.
All right. Thanks, Lisa. See you
All
guys
right.
next
Have a
time
good
then.
day.
Bye.
Bye.